position sizing plans. Well, Cam, I am going to hand you over the microphone, put the spotlight on you, and off you go, my friend.
Yeah, thank you very much. I appreciate the introduction. It's good to be here again. So I've got some really good stuff for you guys here today. So please have your notebooks ready and please take notes. It's very applicable to the kind of setup you guys have with Top Step, you know, with their sort of rules and guidelines in terms of like risk limits on the day, your objectives, etc., which is really a good thing, and not a lot of retail traders have that. I sort of realized that when I went into prop trading back in 2005, which is 10 years ago now, and every prop trader has a risk limit, and a lot of retail traders don't have that. So they basically can lose as much as they like, especially with these, you know, crazy margin requirements and allowances that they have. So you guys are in good hands because you do have risk parameters in place. But what I wanted to add on top of that is actually sort of work with your own model and work with your own risk and position sizing plans, because it needs to be very personal and unique. So I'm going to show you some insights into my own position sizing plans, models, risk management models, how I build them, and basically give you some ideas for the certain combines that Top Step Trader offers. So you know, I think you guys are going to really find this valuable. So I'm basically going to get straight into it. So let me just give through a quick disclaimer. I do not have any knowledge of the trading needs, objectives, or interviews of the presentation. This presentation represents suggestion, training, and information for viewers to use when evaluating making trading decisions in light of their own individual trading goals and does not constitute specific advice. I do not take into account the trading objectives, financial situation, needs of any particular person, and before making a trading decision on the basis of any information shared, the prospective trader needs to consider with or without the assistant advisor whether the advice is appropriate in light of their own particular trading needs, objectives, and financial circumstances. Trading the markets involves risk, revenue can be gained, and expenses may be accumulated. So let's get into the main meat and bones of this presentation. So position sizing and risk management is probably, you know, phrases that you guys have heard. But however, my journey with working not only with myself but with many traders over the years has sort of shown me that not many people really understand position sizing and risk management to a degree that can really be effective. You know, the typical understanding of a risk management plan is like putting a stop in, having a target in place, etc. You know, having sort of a drawdown limit as a whole for the account, etc. But as I said, you guys are in good hands because Top Step Trader does provide a risk limit on the day, etc. And you got to try to avoid hitting that. Which brings me to a point really, because that risk limit is like your risk. That's like absolute worst case scenario. So you shouldn't push to hit your risk limit every day. I learned this as a prop trader, and basically if you push for your risk limit, which is the natural tendency for a human being, because human beings don't like to lose. So what we will do is we will take more risk in order to not lose. But if we are, for example, in profit and we are up in the green for the day, we will be less likely to take risks. So it's sort of the opposite of what you want to do. So the risk parameters are there to really protect you. But if you're just waiting until you hit that risk limit, you're probably going to be risking more than you're actually making. So therefore, you don't actually get anywhere. So the idea here is to really show you how to create more effective risk management and position sizing plans like I do, and show you how I sort of look into these and build them. So firstly, markets are not dynamic. They are fixed. Sorry, let me say that again. Markets are dynamic. They're not fixed. I beg your pardon. It's a bit late in the day for me. Markets are dynamic and not fixed, right? So the markets are completely dynamic. They're always changing from one day into the next, from 1 month into the next, etc. So they continuously do change their dynamics, right? There is a natural rhythm to every market, but they are living, breathing organisms. Like, that's the way you got to see them. They're not fixed. They're not always making the same move every single day, you know? So they are changing all the time. I've seen this over many years. You know, there are many dynamics to a marketplace, and there are certain things that make up a market, and there's certain things you need to pay attention to because they do change over time. So I'm going to give you some insights into some things to watch to sort of understand the market dynamics are changing, and you may need to adapt basically. So dynamic parameters, in my opinion, are essential for effective plans. I believe you need to have a very dynamic model so you can maneuver in the marketplace. You still have structure, so don't get me wrong, you still have structure, but you can maneuver within that plan. So the typical new trader that comes into trading, they will set a fixed stop and a fixed target. So for example, E-mini S&P is a very popular product. A very common stop is like 6 to 8 ticks and go for like 8 to 10 tick target. Now, what a new trader will think is basically, oh, I'm risking less, looking for more. So over time, if I keep trading that plan, I should make money because I'm risking less to make more. But the reality is it doesn't work that way. So what you find is that you really have to keep an eye on the bigger picture and what sort of accumulates over a longer period of time. I often say like about 3 to 4 months, but ideally 6 months to 12 months is really sort of a great indicator to performance. So you have to have dynamic parameters in place. So how do you build these, and how do you basically have structure, still limits on the downside and the upside? How can you build that without being too fixed? So, this is really something that I had to come up with and think of. It's not something I read in a book or learned anywhere else. It's basically, for me, it's just common sense and the thing is, with common sense, it sort of goes out the window for most traders because unfortunately we get stuck in this journey where we are in the hunt for discipline and more disciplined trading, because we keep hearing this word. You need to be more disciplined. You need to be more sort of fixed with your trading plan. You've got to have a system. Don't diverge from that system. So we get stuck in this world of like fixed rules, fixed settings. You got to find discipline by being sort of fixed in a way. So you start becoming like a robot. So you lose your ability to really sort of think on the fly. And my job really as a trader and a coach is really to help traders get that back. So to remember that you're a human being, you have feelings, you can think on the fly, you can maneuver around a plan but still have structure. So the way you do that is you have some parameters but you don't keep them fixed. So I'm going to show you how. So things you define for each market that you trade, firstly is a daily risk limit. So I say ideal or typical kind of risk for that market, or maximum risk as well, because the market dynamics will change. They will get more volatile, they will get faster, they will get quicker, and you have to be prepared for that. You can't just sort of make it up on the day. You have to be prepared for that in advance. The daily objective needs to be set as well. So you've got to have an idea of what you're aiming for, and if you hit that objective, you've got to stop. If you also position size in terms of scaling in, scaling out of trades, which I do, and I highly recommend that you do sort of at least scale out of trades. But if you're scaling in and scaling out of trades, you really need a dynamic risk management plan, because you can maneuver around that but still have that structure. So you have to set that, but at the same time, it's not fixed. It's not like, okay, I buy 10 and then I buy 10 more, then I buy 10 more. It's not like that, because you've got to use the market dynamics in real time to actually decide when to put the rest of the position on, but you still need structure. So the point is, don't be fixed, but have a structured approach. So you can still stay disciplined, but you've got room to maneuver. This is what I realized through experience that you need to have in place. I've never read this in a book. I've never heard this in any seminars. I basically come up with this idea because that's what was common sense for me. So for some of you, it's going to be like an eye-opener. You probably haven't even thought about it because you become so fixed. Some of you may already be using very similar like parameters in already, and you're on the right kind of path, in my opinion. So risk levels, specify these in ticks and also monetary values for each position size, because each position size requires a different risk level. So let's look at some examples. So I'm going to show you some examples that I work with. Just give me a moment. So the Bund is like probably my main market, because that's the market I go to first to look for trading opportunities. Okay, so I've just opened this up. So basically what I've got is just a simple Word document. You can use any word processor or, Excel sheet, it doesn't matter. But the thing is, what I've got, firstly look at the legends. I've got light size, lower target size, upper target size, heavy sized. So basically I've got an indicator of when I am lightly sized up in my position in terms of my risk parameters. So in the context of my risk parameters, am I lightly sized? Am I sort of mid-sized, heavy-sized, etc.? I need to know that. So I've got that in place, but I've also got these rules, which are really important. So I've got risk management rules, and these are about the only things that stay fixed in my trading plan. 2 COBs, basically that's 2 losses. I don't use the word loss because I don't think human beings that are trading should use the word loss, because losing has a deep down attachment to pain. And that word loss, loss of a loved one, loss of a trade, or loss of money, it basically is painful on a subconscious level. So I don't use that word. I use expenses and I use the cost of doing business. So because trading is a business, and I think you've got to see it that way. It also makes it easier basically to accept your trades that you're wrong in. So I don't call them losses, because you're not losing because of one trade or one day. You're just sort of incurring an expense, a cost of doing business as a trader. So I call it a COB. So if I have 2 expenses or 2 trades that don't work out in the same day, I stop trading. 2 gains, I stop trading. Okay, 3 trades as a maximum, that's the most I can take, I stop trading. If I'm close to my daily objective, which is set here, I can basically be like a few €100 short, or I might be in the range. So it's not exact, but if I'm close to it, I'm going to stop as well. If I'm close to my daily risk limit, I'm also going to stop. So my job really is to avoid hitting that risk limit, which really is your job as well. Even with top step traders parameters, you've got to sort of avoid hitting that risk limit. So I'm going to show you some risk management models that I put together for different combines, so you can see how it works. So basically the capital allocation that I work with is a 400 grand account, euros, okay? So with that, 1.5% gives me ability to be able to use 5.5 grand risk limit. Now, keeping in mind, this is what I was using until May 2015. Because if anybody's been trading the Bund, and I will show you how I recognized it, it changed in May 2015, and it actually hasn't changed back. Okay, so I'm still waiting for that to change back. So this is where I personally had to adapt my risk parameters, my position sizes, because the market changed. Now, the last time the Bund had this level of volatility was in 2011. And back then I was trading the Euro stocks. I didn't even trade the Bund because I was too scared to touch it. I didn't want to trade it with that level of volatility. Now I have a bit more experience. I'm a bit wiser. I know I can adapt and I can drop my sizes, etc. So basically what I did is I created this plan in my live mentorship room in real time. I said, look, the market's changed. These are the dynamics now. It's not the same Bund that I have been trading for the last 3 or 4 years. This is now a different market. So what I said is I'm going to adapt. I'm going to change my position sizes. I'm going to drop them. I probably have to use wider stops because this market is not going to respect a 7 to 8 tick stop anymore. It's going to respect a 10 to 12 tick. Quite often at the moment I'm using about a 14 tick stop on the Bund because it's changed that much. And when it goes back to its normal kind of rhythm, I will go back to this model. Okay, so I've got different models for different kind of phases because the markets do change. So basically I created this model real time because the market changed. Okay, I had the ability to do that because I understood the market dynamics and I understood it changed, but I was also willing to change. Whereas if you're fixed, you won't do that. You will just keep sticking with your stops, your targets, and you will sort of enforce that upon the market, which is not the right thing to do because the market is ever changing. It's always moving, it's dynamic. But if you're fixed and you're trying to stick it out for the long term in this business, you're not going to last because when the market changes and your parameters don't fit that marketplace and the market dynamics, you're going to get stopped out prematurely, your targets are not going to get hit, etc. So you have to adapt. It's not like, do you have to, or should I, or maybe I'll just leave it alone. You have to. If you're going to survive, you have to adapt. Because if you think about any business really, Every business, doesn't matter what business you're in, marketing, retail, it doesn't matter, right? Every business has a marketplace they do business in, and that marketplace changes. You know, if you're in for example, the technology business, if you're not on top of the trends in software, technology, etc., and you're not adapting, and you're not changing what you're doing, and you're not, for example, staying on top of the trends in that marketplace, you're going to get taken out of that marketplace. Somebody else is going to take over. You're going to lose your position, right? So what you have to do is you have to adapt. You know, the marketplace that you're trading right now, even the S&P, Bund, Euro stocks, whatever it is, crude oil, those are marketplaces that are continuously changing their dynamics. So you have to be able to recognize when they change. I'm going to give you some tips how to do that later today. But basically, I just want you to have a look at my Bund model right now, because I'm still trading this. But I've also got something to watch for when to change this, basically. So what I'm doing basically is, just give me a second here. What I'm doing here is basically adapting to the marketplace, but still having a risk management model, a position sided model, so I can still trade, but at the same time, I know the market's changed. So what I have is my risk limit dropping, my objectives change, same capital allocation, that doesn't change. But now I'm starting my trades with 5 to 10 lots and then trying to scale up to 15 to 20 lots, okay? Every position size has a different stop size, 10 to 12, 10 to 12, and when I get heavier, it drops, 9 to 10, 8 to 10. But not only do I have that in ticks, I also have it in euros. So I know what that position size is going to cost me with whatever stop it is. So what you do initially is you print this out and you stick it on your desk and you watch it. And every time you got a position on, you look at what kind of position you got on. You look at what your ideal risk is. You look at what your maximum risk is. The key thing is that you never take more risk than your maximum risk. Okay, that's got to be worked out beforehand. So for example, on like 10 contracts, I can risk 20 ticks. I don't have to, but if I do need to, because the market is that volatile, I can. At least I know I can, so I'm prepared. So I can put a 20 tick stop in all of a sudden because the market's that volatile, it's moving that quickly. I might need to do that. Now before like May 2015, I was using 7 to 8 tick stop losses pretty much most of the time on the Bund. But now I've been using 14, 15, 12 tick stops. You know, every trade is different because it depends on your entry, where you got in, where the logical stop should go. So at least I can maneuver. So when I look at my trade and I'm going to get in, I can put my trade on. If I'm unsure, I put a smaller size on, and I've got my maximum risk in ticks already available. So I know, like for example, if I put 10 contracts in on the Bund, I know if I do need a 20 tick stop, it's only $2,000, and that's half my risk limit on the day. So it's highly unlikely I'm going to have to take that kind of risk, but if I do have to, at least I'm prepared, you know. So the idea here is to be prepared. You know, you'll also note down here, I've got a separate risk management model for December trading because I dropped my size in December. It's the end of the year. ECB, FOMC days, those are days where I drop my risk as well. Rollover days, other days where I decide to use less risk because, you know, for example, we've had the Greek debt situation. That's been hanging over our heads for like actually a number of years, but it's sort of come in to the marketplace again in May, and it's still sort of there. It's sort of started to filter out now, but what happens in the marketplace reacts to that, and you sort of have to adapt because, you know, we started getting gaps every Monday on the Bund, the Bubble, the DAX, the Euro stocks, you know, every other day because the ES, the YM, and the Nasdaq was responding to news overnight. That doesn't happen most of the time, but when you got something like that going on, it does. So I might come in the next day and I think, wait a minute, this market's hugely volatile, it's responding to news, and I think, okay, I better drop down to this risk management model, not risk 20 contracts, 30, 40, because I'm no longer comfortable risking that level of position size in the current marketplace. So I adapt as I need to, you know. So take this metaphor on board, please, because I use this a lot in my live mentorship room. Basically, you know, think of trading like you're playing a sport. Okay, so whatever sport it might be. So in the UK, we call it football. You guys call it soccer, right? In the US. Now, soccer or football If you're a football player, professional football player, you go on the playing field, okay? You cannot think like a robot. You're not going to do the same kick every time the ball comes your way, you know? But that's exactly the same as going into the marketplace and using the same stop and same target every single trade. You're like a robot, right? But the market is dynamic and you're fixed. You know, you go into any playing field. Like if you're a professional boxer for example, and you go into the ring and you're heavyweight champion, you're having a fight, so you're defending your title. Now, if you sit there and do the same jab, left jab, left jab, left jab, you're not going to get anywhere because you're not dynamic. You're not responding to your ever-changing environment because your competition is adapting, but you're not. And in the marketplace, the competition is always adapting. And if you're not, basically the competition has you. They have that edge over you because you're not adapting. So in this marketplace, you have to adapt. It's like playing a sport. Okay, so you have to be prepared to use a wider stop, push for more on your targets, etc. Okay, so I've got some questions coming in, but I'm going to finish my presentation first, if that's okay, Eddie, and then I'll take the questions later. So basically, let's move on. So you have to be prepared for the unexpected. That's what I'm saying, basically. So, the last 2 months or 2.5 months were a good example of that, actually, because the marketplace has changed, especially in the European marketplace. The Bund has been a different market to what we are used to, what I'm used to. I've been trading it for years, but it's a different market. At least I had to, I recognize that and I adapted, but there are many traders that won't, and they will enforce their fixed stops, their fixed targets upon the marketplace because that's what they're used to, but that is not going to really cut it in the, the real world. So being prepared for the unexpected is absolutely essential. You never really know when the volatility in the marketplace will increase or decrease because, the summertime trading typically is quite slow. It started to slow down recently this week, but you never know when it's going to pick up. I've had June, July, August, which have been really, really volatile on the Bund, for example. Even the S&P, it's been pretty good for summer so far. So this idea of summertime slowdown, etc., not really been in place until like recently this week. So you never really know, to be honest, you never really know when the volatility is going to increase or decrease, but you better be prepared for when it does. So you should always have a plan ready for those scenarios. You don't know when it's going to happen. Okay, that's the point. Okay, so you don't know when the volatility is going to increase or decrease. We all have these ideas. December, there's a slowdown. Summer, there's a slowdown. But the reality is, it might not happen, so the reality is, like, the summer might actually be the best period for the whole year. You don't know. So you don't know what's going to happen around the world and when the volatility is going to increase or decrease. So you've got to be prepared for that. Your plan has to be ready for it. Okay, the worst thing you can do is on that day, just say, oh, wait a minute, the market's moving loads. Let's just trade as much as we can possibly do and basically just hope for the best. You got to be prepared. If I'm unsure about the marketplace and the dynamics, I sit there and I wait and I sit back and I watch the market until I can get a feel for it again. Because if I don't understand that marketplace, I'm not doing business. I'm not confident putting risk on if I don't understand the marketplace and I don't have confidence doing business in that marketplace. So when a market opens up and I think, wait a minute, this is crazy, I sit aside and I wait. Whereas a new trader will think, wait a minute, this market's moving so much, I better get in because I'm going to miss out. So the mindset is completely different with new traders and professional traders that have been doing this a long time. So more than likely, your risk and position size parameters should be different in more volatile phases. Like I've just showed you for the, the Bund. I'll also show you for the DAX, the Euro stocks, and I'm going to show you also parameters that I put in place for like the combines. So generally, it's best to drop size and widen stops, as well as push for more on your targets during more volatile periods. And in slower periods, it's advised to basically tighten up your stops and also bring your targets closer, make them tighter in slower periods. It's sort of common sense, really, if you think about it, because if the market's moving more, it's moving more quickly, you might have to drop your size, but you can actually get more out the market with a smaller position size, So So basically, these are the things you want to take into consideration when you're creating your plans. Okay. Now, I'm going to talk a little bit about things that you can use to gauge your volatility in the marketplace, your daily ATR, 3 to 5 minute bars, market pace and rhythm, swing rotation sizes. So I'm going to move to the charts and show you some of the things that I look into to really sort of gauge this stuff. But before I do that, I'm going to talk about the combine parameters that I've got in place. Hold on. Just give me a moment. Okay, so what I've done here is basically built a very similar model, but I have personally looked at the Top Step Trader Combine parameters, etc. So I've got actually quite a few guys, students of mine over the years, which have actually got funded with Top Step Trader. Using some of the the concepts that I've shared and basically taught them. Obviously, they're fully responsible for their success and what they've achieved. But what I've often had to discuss is, these parameters here. So the typical trader is going to sit there and think, okay, well, I'm going to open up a 50 grand account, or I'm going to join the 50 grand combine. My maximum position size is 5. My daily loss limit is $1,000. My max drawdown is $2,000. So what I'm going to do is basically trade 5 lots, and I've got a loss limit of $1,000. Now, let me sort of show you the reality of this. If you do trade 5 contracts on for example, the E-mini S&P, right? That is $62.50 per tick. Now, if you take one stop out for 10 ticks, which is, quite a typical stop for the E-mini S&P, that is $625, right? It's not wiped you out for the day, but you're not far away from your daily loss limit, So then you have to drop your size because you've traded a 5 lot. Now you can't trade a 5 lot again, because if you risk the same again, you've already hit your risk limit, So that's just common sense, really. But as I said, common sense is not common anymore. It should be, but it's not. So you got to bring that back. So you look at this and you think, wait a minute. So I've traded 5 lots. I've risked $625. Now I've got what? $625 take away $1,000. You've got like $375 to play with. Common sense would tell you can't trade a 5 lot again, and if you do, you've got a really stupid tight stop. So the reality is you've got to drop your size now. So once you take your first trade, your position size in the next trade may have to change, right? So you've got to take that into consideration first. Now, if you look at this, for example, your max drawdown, okay, because I've seen people do this. I've had guys that I've been teaching join the combine, and guys will go there and they will join the combine, trade 5 lots with $50,000 combine, and they will hit the $1,000 risk limit one day, and the next day hit it again. Now they've hit the max drawdown, so they're out. They can't keep going. Okay, so you're basically using too much risk too soon. So what I've got in place here is what I would do. Okay, so these are the combine parameters that I'll be looking at. So firstly, we can start with the $100,000 combine. Okay. So we've got the $100,000 combine. Now, Top Step Trader, they recommend a $2,000 risk limit, which is 2%, which is good because, retail broker is not going to give you that, They're going to let you trade as much as you want, and you can basically lose, your whole account in one day if you like. But, at least Top Step Trader does put a risk limit in, and that's very, very essential in this business to keep in the business and basically make it. But if you basically look at the risk parameters that I put in place, I've got 1.5% risk, which is $1,125, right? So now with that, I've now not got a fixed position size. I've got like a position size all the way from 1 to 8 contracts. Okay, so I'll work this out for 1 to 8 contracts. Now, for every position size, I've worked out the typical average risk I might have to take under current circumstances. Okay, so that might be right now, for example, 10 to 14 ticks, 10 to 12, 8 to 10. It doesn't mean you're going to take 14 ticks or a 12 tick stop, but if you need to, because you get into the trade and you look at it and you think that's what I need, That's what market structure suggests. Because I basically recommend market structure stops. But sometimes you can't afford the stop the market structure requires you to take. So you've got to be prepared for that. So if I look at a trade and I think, oh, wait a minute, I need a 12 tick stop, but I can't use a 12 tick stop with 20 contracts. But with 10 contracts, I can. So I'll put 10 contracts on instead. So you've got these parameters in place. It provides a structure so you can still adapt, but at the same time, you're not fixed. So you still sort of got a guide, but it's not fixed, right? So you got, this risk management model is just an example, but if you're scaling in, you can start with 2, you can move up to 3 or 4 if you're building up your position, because I do that quite a lot. If the trade is just starting off, I start smaller. The better it looks, the more heavier I get. Now, the downside of my style of trading is that if the trade moves very quickly, I might get stuck with a very small position. So I've got to make sure I put enough on, but not too much. So because I don't want to sort of put all my eggs in that one basket. So as a scalper, you probably want to go all in, all out. Now, I don't scalp. I trade around longer time frames, sort of chart setups that can last anywhere between half an hour to 2 or 3 hours. So, they're pretty much longer time frame intraday trades. So I like to scale into those trades. But if you look at like the parameters here, you can choose. You look at the trade and you say, wait a minute, I'm going to start with 3. I'm going to put a 10 tick stop in. You already know it's $375. That's way below your risk limit, even if you get stopped out, So you can sit there and take another trade again. But now let's say, for example, you scale in right to 6 contracts and you use the 10 tick stop. Now you've risked a big chunk of your risk limit on the day. So that for me would say, basically, look, if I've scaled in from 3 to 4 to 6 contracts, I might say, wait a minute, I've taken a lot of risk today. The chances for me to bounce back from $750 down is pretty slim with what I've got left to play with. So I might as well just take the day off, come back tomorrow. So what I do is I cut my risk very, very, very low. I make sure I always stay below my risk limit. But if I get anywhere close to my risk limit or I'm getting in that direction, I sort of review the situation. I ask myself, is there any point continuing today? Now, the typical trader, because human beings don't like losing, so they're going to take more risk when they don't want to lose. So they take more risk in order to sort of avoid losing. But what you got to do is basically be very humble. You got to say, look, let's just cut it off, come back tomorrow. Now, that takes a lot of skill. It takes a lot of discipline. But the reality is that's the best way to do it. Cut your losses, come back tomorrow. We've all heard it before, but I would much rather sleep on it, do my analysis again, come back fresh-minded and trade again the next day. If I'm anywhere near my risk limit, never ever exceed your risk limit, okay? So now next combined parameters, you can see here 1 to 2 contracts, you've got 20 tick stops, you might have a really volatile phase. For example, I don't know if any of you guys traded even the S&P, YM, NASDAQ in January 2015, but it was really volatile. Quite often you needed basically 14, 16 tick stops. Now, somebody hasn't adapted to that, and I know basically a lot of traders, even that I coached, did not adapt. So, they're sitting there still using 6 to 8 tick stops, and they're wondering, why am I getting stopped out? I always use a 6 to 8 tick stop, but the market keeps stopping me out now. So, basically, they haven't adapted. They haven't realized the market has changed. They haven't recognized the market has shifted its character. But you have to survive. So if the market does change, because it will, it might be 2 or 3 times in a year you get that volatile phase. And when it does, you've got to adapt. So you've got to use wider stops, but you drop your sizes. So you can still take the same level of risk, right? So next combine, 50 grand account, which is pretty much the one that most people go for. Now, what's the limit there? The limit there for $50,000 combine is 5 lots, right? Now, see what I've done here is I've broken it down. I've still got 5 lots there, but that's the upper target size. So when you're scaling in, you sort of aim to get to that size, but you start with like 2 or 3 contracts. You've got enough to play with, but you're not putting all your position on in one go. So you're sort of looking for the market to give you more clues. and basically then make your choice decision. Shall I get heavier? Shall I stay smaller, etc.? So what I do is I basically would start with like a 2 lot, 3 lot, move to 4 or 5 if I feel comfortable, if I feel confident in the position. Okay. Now I do that based upon market conditions, market, what my plan was, my visions. Is the market still holding my premise for the trade? Because you don't want to sit there and scale in because you're losing, which is a big mistake. Because if the market, let's say for example you're long, but you don't want to accept that you're wrong, you don't want to just buy more because you want to move your entry price lower and you don't want to accept you're wrong. So this is where it gets a little dangerous when you're scaling in, because the tendency for the trader that struggles to accept losses, or the cost of doing business as I prefer, will probably be to get bigger when they're losing, which actually the right thing to do is get bigger when the trade's actually working out. That took me a long time to realize, and that's what I try to work towards myself. I've been working on that for the last 4 years, but it's still work in progress. But that is the right way, in my opinion. Get heavier, get bigger when the position looks better, not worse. And if you look at that, the psychology is a bit sort of counterproductive, because the psychology of a typical human being is to get bigger to avoid losing. So they can basically pull their entry price lower if they're long, or higher if they're short. But the right thing to do really is, if the trade's working out, get bigger, which actually pulls your entry price further up if you're long, or further down if you're short. And a lot of people don't like that, because they're thinking, wait a minute, I'm actually worsening my entry price. I'm actually making it worse. But the reality is, look, if you believe in your idea, you believe in that trade, you should have the confidence to do that. And that's what I'm trying to do. And I've been working on that for the last 4.5 years. And I'm still trying to get better with it. I admit that. And I always say, look, I try my best, but sometimes the market conditions don't allow for you to get bigger, because it moves so quick, or basically, the market looks like it doesn't want to move, and then it does all of a sudden. So it's not always possible, and that's a difficulty in this business. The reality is, the market doesn't make it easy. I quite often joke the marketplace is a magician. It's like this brilliant illusionist, this magician, which plays these tricks on people. It makes it look like it's going to go higher when it's going to go lower. It makes it look like it's going to go lower when it's going to go higher. And that's something you got to recognize. The market is it's kind, but it's not that kind. That's why I don't overstay my welcome, and I say, look, 2 gains. It doesn't matter how big my gains are, how big my wins are. I'm going to take them and I'm going to go, because the market's been kind enough to give me 2 winners on one day. The likelihood of, the way that I trade anyway, to get 3 or 4 gains in the same day is very slim. Now, if you trade as a scalper, which is quite different, you probably can get 3 or 4 gains in a row. But even then, 3 or 4 gains in a row, any more than that, is quite unlikely. The market is kind, but not that kind. So basically, if you look at the 50 grand combine, right, I've got a $800 to $1,000 objective, risk limit of 750, which is 1.5%. Now, the top step trader daily risk is $1,000, right? And basically what I would do, I would start typically with 2 or 3 contracts and see if I can get heavier to 4 or 5. Now, if I went straight in with 5 and I was unsure about my trade, or I think I was a little bit early, which is going to happen, because the market doesn't give you perfect setups. It gives you many unsure setups. So a lot of the time I think, well, I want to be long, but I definitely don't want to be long 20 contracts, but I'm okay with 5, So I sit there and I think like that. So I would look at that position, I look at the opportunity, and I think to myself, well, if I didn't have a plan like this, I have to go in with 5 or 6, whatever it is. But I can start with 2, 3, and as the position is open, as I get more confident, I can scale up, buy another one, get 4, buy another one, buy 5, right? So now you get 5 on. You know what your typical average risk is, 8 to 10 ticks, which is going to be $500 to $625. Now, if you have to use your maximum risk, if it's a more volatile situation, it's $750. Now, if you put 5 contracts on and you have to use a 12 tick stop, you've already hit your risk limit in one trade. Okay, so this is why it's so important, because many times, you know, if you don't sort of look at this in detail, you might end up getting to a position size which is so heavy that it's going to exceed your risk parameters or get you there just in one trade. You know, you really want to give yourself at least 2 shots. So if you do scale into a trade, in a way, you basically have taken 2 trades in one trade. At least that's the way I look at it. Now I'm going to quickly look at a $30,000 combine account. Now, Top Step Trader recommends $500 risk limit on the day. I recommend about $450. Objective of $400 to $550. Now, there is a way to work out your objectives. I haven't got time to get into that because I've only got like an hour. So basically, I'm just going to talk about the risk, you know, and the dynamic plans. But, you know, here, if you go with three contracts, right, you got $300 risk on 8 ticks. You're very close to your risk limit already. You know, you got $150 of risk left to play with, which is probably just 1 contract, maybe 2, but you got to have a very, very tight stop. So, you know, the reality is with a $30,000 account or combine, you probably want to start with 1 or 2 contracts at most. You don't want to go straight in with 3 contracts, okay? Even though you look at the parameters here, it's 3 lots, maximum position size, but that's max. It doesn't mean you should trade 3 contracts all the time, you know? And basically that's the point I'm trying to get across, right? So let's look at the charts a little bit, and I'm going to talk a little about the kind of things that I look at to sort of gauge if the volatility is shifting or changing. Now, if you look at the Bund, like that's my main market. That's the market I'll move to in the European session to see if I can trade firstly. If it's not setting up, I will move to the Euro stocks. But if you bring your eyes and your attention to this pane right down here, okay, can everybody see this? I just want to make sure, Eddie, if you can let me know that you guys can see my charts now.
Yeah, we got charts.
Okay, good stuff. So basically what that is, it's a true range indicator, right? It's a very common indicator. Most trading platforms and charting platforms have that built in. Now, if you look at that, what I've got is basically the daily range every single day plotted with this true range indicator. Okay, so Mr. Guardi has just logged in. Where can I see the charts? Eddie, I'll leave that one with you. So basically, if you look at this, you see when this picked up, like it moved higher. Basically, what this is plotting is the daily range, low to high or high to low, okay? Now, this does include gaps, but I like to look at gaps as moves. I don't think of them, you know, I don't think of gaps as not a move. I think they are a move. So this does include gaps. There are ways to take out the gaps, but I don't take them out. So what I do, I look at this daily range. And if you look at my risk management model for the Bund earlier, what I had written down was something that I'm waiting for. Very specific, right? If you look at this, what I've put here is a minimum of 3 days volatility decrease, or ideally daily ATR below 80, which is 80 ticks, 80 points, right? Now, if you look at where we are, right, that white line, the top one is 80, right, 80 ticks. The one below is 50 ticks. Now, the Bund typically under normal rhythmic phase, when it's trading like it normally does, stays below 80 tick ranges on a consistent basis, maybe the odd day just over, right? But now what we've had, if you look at this, since May, is daily ranges always pretty much above 80 tick range. So, you know, that's just one simple indicator. Now, the last time we saw this on a consistent basis was in August 2011, you know, when we had that really volatile phase, and that lasted pretty much until Jan 2012. So you can see here, the last time we had this was back then. Now, I was there, and I was trading the Euro stocks mostly. Yeah? So I recognize, wait a minute, the Bund has changed. But I see so many Bund traders trading this May, and they haven't even recognized the Bund has changed. You know, and they're supposed to be Bund traders. You know, if you're a Bund trader, you got to know your marketplace. You know, if I do business in the soft drinks industry, you know, I've got to know Coca-Cola and Pepsi. You know, I've got to know who's, who the big players are, right? Now, if you're trading the Bund, you're trading the E-mini S&P, it doesn't matter what market it is. If you don't know that marketplace, you can bet that your competition does. At least the professionals, the people that are doing this on a consistent basis, right? So you got to know your marketplace. I mean, this is the absolute minimum, like daily ranges. So I've said, like, until we get 3 days minimum, right, below 80 tick range, this market is still volatile, right? Now, that's not the only indicator that I use, okay? So there are more. So I've got 3 to 5 minute bars, wider or narrow, okay? So if you look at the footprint for the Bund, for example, now I've got that on 3 minute bars, but if I put that on 5 minute bars, now these are footprints, and I'll watch these for entries. Basically, shows the order flow. Now, if they start getting really wide, that means the market is moving very quickly in a short period of time, because these are 5 minute bars. That's why I like 5 minute and 3 minute footprints, because I like the concept of time to measure volatility. Like, for example, if we make a move of 30-40 ticks in 5 minutes, I know volatility has increased for that market, okay? But if that market is making like the typical 7 to 10 tick kind of rotation in 5 minutes, I know it's typical, right? But if you look at some of the moves that we've had, we've got some big moves in short periods of time, like not all the time, but you will get them. The ES is very, very, very clear with this. If you apply this to the ES, typical sort of range for a 5 minute bar on the ES is about 2.5 to 3.5 points, okay? But if you look at what's been going on for the last 2 months, you get so many 5 minute bars that are like 6-7 points wide, sometimes even more, So, like, for example, look at this Bund move, 04s down to like 74s, right? That's like 30 ticks in one 5 minute bar. So what that sort of lets me gauge intraday is, wait a minute, we just made a 30 tick move, at least more than the typical sort of 7 to 10 tick move, in 5 minutes. Now that's just one bar, but if it keeps happening, one 5 minute bar into the next, so maybe over like 10-15 minutes, you sort of got an idea, wait a minute, this market's getting more volatile. I better look at my position sizing plan and figure out what kind of risk parameters I should be using, because I shouldn't be using the same that I was, maybe yesterday, so you get the idea, right? So, very simple concept, but, it just requires a bit of common sense, which is not common, as I said. So market pace and rhythm. Is the market moving quickly? Now, if it's moving a very far distance very quickly, for example, the E-mini S&P is a very popular market, right? With many of you guys, with many of my students. Now, the E-mini S&P, if it moves, for example, 5 to 6 points within like 5-10 minutes, that's a lot, right? If you know the E-mini S&P. So you know something's changed. But if the E-mini S&P makes a 2-point move in 5-10 minutes, 3-point move, you think, okay, that's pretty normal. So you know that market, you know what's normal and what's not. So you know the pace and rhythm of that market. So always take that into consideration as well, right? So what about swing rotation sizes? These are, some things that I look at as well. If you look at the Bund, for example, like intraday, this is a 4-tick Renko chart. I personally like Renko charts, so you can use them. But if you look at some of these swings, like this market typically makes swings that are like 10-15 ticks, maybe 20 ticks at a time. But you look at some of these swings, they're like 97 ticks, 34 ticks. It's not that wide today, but if you go back, you're going to find some massive swings happen on a consistent basis, like 68 ticks, then one swing, 68 ticks there, 65. That tends to be quite a little bit of a rhythm there, right? So 68 ticks, 65, 66, 68. So you can see those are big moves for the the Bund. 1.08, that's 108 ticks, which literally happened in like 5 minutes there. So that's not normal, for the Bund. So if you trade the Bund, you should recognize that. The issue is, if you trade like 10, 20 different markets intraday, you've got no chance understanding when to adapt, because you're looking at too much. So that's why I keep my markets very limited. I trade the Bund. If the Bund's not setting up, I trade the Euro stocks. If that's not setting up, I trade the DAX. If I don't get anything there, I'm moving to the E-mini S&P during the US session, and that's it. So I've got like 4 markets to stay on top of. But now I'm experienced. I've been trading over 14 years. I understand these markets and the dynamics. You know, when I first started, I didn't look at anything else apart from the YM, the mini Dow, because that's what I committed to. That's the market I wanted to understand. I still understand it, but now I understand more markets. But the majority of new traders don't really know the marketplace they're doing business in. They don't really understand, is this normal? Is this abnormal? They don't really know. But you should know. If you're doing business in that marketplace, you have to know, is this normal or is this abnormal? You have to be able to answer that question, because how else are you going to adapt? Because you need to know, should I take, more risk in terms of stops? Should I use less of a position size? You have to know that. If you're for example, trading this $100,000 combine with Top Step Trader, how do you know if you're going to trade 3 contracts or 6? You should know, because you understand the market situation in the moment. Because you understand, wait a minute, this market's moving pretty normal, natural rhythm. I'm going to start with 3 or 4 contracts, maybe 5, 6. Wait a minute, this market's gone really volatile. I'm going to start trading 2 contracts until this market slows down again, So you get the idea, right? So hopefully that makes a little bit of sense. And so I think I'm pretty much sort of running out of time here, so I might as well take some time to take some questions, if that's okay.
Perfect. You know what, Cam? We've got all the time in the world. You just sort of you're laying it out there, and we're loving it here, and we appreciate it. Fantastic.
If you sort of look at, let me just show you some examples. If you look at the Bund risk management plan that I've got in place right now for more volatile periods, it's sort of based upon the fact the market started making bigger swings on a more consistent basis. So it was moving further in a very short period of time. So that's the first thing I sort of recognize. The first indicator you're going to get intraday is going to be a big swing in a short period of time. So if you sort of think about the markets that you typically trade, and you bring that into your mind's eye right now, and think about what kind of move does it typically make in about 5 minutes. Okay, you should have an answer, right? Now, the Bund, typically in about 5 minutes, it should move about somewhere between 7 and 10 ticks. That's quite normal. You can see that from the footprint. Sometimes just, less, 4 or 5 ticks. Sometimes a little bit more. But you get a rough idea. But if all of a sudden it makes a 30 tick, 40 tick move in 5 minutes, something's changed, right? So E-mini S&P, for example, is a very, very common market. I've actually got it shut down right now, so I don't have it open. But that, for example, has a typical 5 minute bar of 2.5 points to 3.5 points. So that's like what, 10 to 14 ticks, right? So 10 to 14 ticks in a typical sort of 5 minute range, that's quite normal. But if you sort of see that market open up, it moves 5, 6 points all of a sudden in 5 minutes, instantly you should think, wait a minute, these market dynamics have changed. Does that make sense? So you sort of get an indicator intraday from the, sort of looking at the wide or narrow range bars. How wide or narrow are these 5 minute bars? It doesn't have to be 5 minute bars. I mean, I use those. You can be, you can look at 3 minute bars. You can look at tick, volume bars. The thing with tick and volume bars is that they sort of adapt sort of automatically to the market situation, so that's why I prefer time bars when it comes to like footprints. So I think that's the main thing to gauge. And then over time, once you've had a few days of increased volatility, you can actually start looking at, what I was talking about with these daily ranges, so you can start to see like wait a minute, the daily ranges are like 200 ticks, 100 ticks now all of a sudden. If you look at the Bund, right? The Bund here, you can see it started to make some big swings intraday. One day is not a big thing, but if you do that for a few days in a row, like we did here in May, we started to make big swings from low to high for the day or high to low for the day on a consistent basis, like 2 or 3 days or more. That's a sign that the market has changed. So usually it takes about 2 or 3 days for the market to really sort of provide that clue. Actually, we have changed. We've increased volatility. We're willing to make bigger moves in a shorter period of time. But you initially experience it intraday, okay, with the shorter time frame charts, like 5 minute charts, etc. Bigger moves in shorter periods of time, basically. Now, please don't get confused with like reactions to news, because that's going to happen and you're going to get some big moves very short term around news, but it's not going to last. So we are talking about sustained volatility to think, wait a minute, I better drop my size but use wider stops and potentially push for bigger targets as well, right? Hopefully that answers your question.
All right, thank you, Cam, and thank you, Fred. Next question is from Chiri. Chiri's asking, she says, are your targets equal to your risk on each trade? Do you scale out of your trade, or are you all in and all out?
Well, I actually scale in and out of my trade. So it's sort of, I don't always get a chance to scale in, but I quite often get a chance to scale out. So I typically start with my minimum position sizes. So let me just show you the bund. Like recently, I've had a start with like 10 contracts on a consistent basis, like this one here, right? So I start with 10, but if I'm a little unsure, I would start with 5 and then maybe move to 10. But typically I would start with a 10 contract position and then I'll move to 15, 20. Now that's only because I've reduced my risk and my position size. Normally, and for the last sort of 3.5 years, before I had to drop those position sizes, I normally start with 20 contracts, then move to 30, 40. Now, there are many situations where I put 20 contracts on and I don't get a chance to put 30, 40 on. I wish I do, especially when they work out. But this is the thing, right? Everybody wishes and they really want to have more of a position size on when it works out. But you know what? There are going to be some trades that don't work out. So I'm always thinking about risk management, So I'm always thinking, what if this trade doesn't work out? So that's why I start smaller. Obviously, the downside of that is that I might not be able to get that bigger position size on if it does start to, sort of work out. I try my best, but, that's where it comes down to performance, So there are no sort of fixed rules for that. I suppose the only rule I have is how confident am I in this trade to actually get heavier? That's what I ask myself. So as I was saying earlier, the thing in trading, what happens with many traders, they sort of learn they've got to be disciplined. They've got to find discipline. So they sort of think, okay, wait a minute, I've got to be disciplined. So I've got to have some rules to follow so I can know that I'm disciplined. If I've got some rules, I can follow them and I know I'm disciplined. So what happens is people become so systematic, robotic, that what they do is they lose this ability to actually make choices and decisions on the fly. But in a way, what you have to do is sort of remember how to make these choices and decisions. Remember that you are emotional. You're a human being. I'm sorry to say, but as long as you are a human being, you're going to have emotions. So it's pointless saying that, you're going to be emotionless, you're going to be like a robot, you're going to be systematic. So I say to myself, okay, well, what am I feeling? Do I feel confident? Okay, let's get heavier. Do I feel a little uneasy with this position? Okay, well, I better stay with this smaller size and just stick with my stop, If I don't feel good about a trade, I'm not going to even get in. But basically, what I'm saying is you use your feelings, which is quite... It's quite unusual nowadays in trading because many traders have learned to become so systematic, mechanical, like robots. They sort of are scared to use their feelings. But what I do, and many traders do, prop traders in the UK in abundance use their feelings and their discretion every day. That's what we do. That's what we do. It's what we have to do. So, the reality is you have to use your feelings. You have to use your intuition. You've got to say, do I actually want to take more risk or should I sit out and actually just take less? So, that's my answer. So,
thank you, Kerry. Fred's got another question here. Are all aspects of effective plans dynamic, or are there absolutes like loss limit, for example? And how do you know when it's time to change the dynamic components of your plan?
well, as I said, a lot of it is down to sort of understanding the current situation. If you really understand the marketplace and you really build a good plan, you should be able to make those choices and decisions, So for me, it's all about, look, this is what I understand the situation is. Am I willing to take more risk? It's no more complicated than that. Now, if you're looking for an exact answer, it's not going to happen because I can't say to you, look, when this, and this happens, you buy more. When this, and this happens, you sell more. Now, that's the answer everybody wants to hear. But this is the thing, right? The answer that I'm going to give you is the one you need to hear, not the one you want to hear. So the answer that everybody wants to hear is, look, Cam, just tell me what I got to do to get bigger, what do I have to do to get smaller? But the real answer is, look, you got to trust your ability to understand the market situation and say, look, I want to be bigger because I believe in this. I want to be smaller because I don't believe in this. You know, that's the reality of it.
All right. Next question, thank you, Fred, is from Scalper Speed. What kind of tools, calculations, or indicators do you use to determine changes in market dynamics?
Right. Okay. So basically, what I've sort of spoke about earlier, you know, the average true range, the daily true range is one of the things that sort of shows up afterwards. But intraday, you're sort of looking at the size of the swings intraday, how big they are, the 5 minute bars. So it's really sort of what I've just discussed. So you can use like in Market Delta or Investor RT. That's the charting platform that I use. So what I do, I sort of look at the size of the swings, the typical kind of swings, right? On I'm using a 4-tick Renko chart. You can use what you like, but basically the typical kind of swings that we see in this marketplace, are they increasing and are they happening in a shorter period of time? Like for the Bund, for example, if you look at today, you know, a lot of these swings are a lot bigger than we typically would see on the Bund in a short period of time. Actually, not today, over this whole period, which is pretty much Wednesday, Thursday, Friday. So a lot of these swings, like 90 ticks down, 46 ticks up, this is bigger than the usual swings on the Bund. Right? Every market is different, right? So you got to sort of understand the dynamics for your market. And now I often do sort of rotational studies. You know, you can export all this data and it basically will show you how frequently certain size of swings happen, you know. So I've got those studies sort of already done. So I do sort of take that into consideration as well. And if they're not happening on a consistent basis, you know, you sort of start to see that, wait a minute, the market dynamics are changing. So if I can just sort of show you some studies here. Just give me a moment. All right, here's a Bund rotation study on 5-minute bars until April 2015. It's got to wait for a load. All right, so if you look at the Bund here, this is a rotation study since January 2013 to April 2015, which is basically based upon that indicator which I just showed you, which is called the zigzag indicator. Now, I haven't really got time to go into how to do this, but it's quite straightforward. I mean, if you drop me an email or something, I'll be happy to sort of point you in the right direction. But if you look at this, what I've done is I've sort of created these ranges, 1 to 5 ticks, 6 to 10 ticks, 11 to 20 ticks. So what you notice straight away is the Bund typically makes 10 to 20 tick rotations. You know, this is based upon 2 years, over 2 years. So, you know, when we start seeing these 21 to 70 tick rotations, like all of a sudden, you know, which are there quite frequently right now since May, you know the market dynamics have changed because we're not making the typical kind of rotations this market makes, which is 10 to 20 ticks. You know, so you can do stuff like that as well. You know, so you can look at the data, you can actually export it, you can analyze it in, you know, Microsoft Excel or any other spreadsheet software. So, you know, those are things that I do anyway. So, but the main thing to really sort of watch is intraday action. You know, is this market moving quicker in a shorter period of time? Is it moving a lesser degree in a, you know, the same kind of period of time? So, like in 5-10 minutes, how far does this market typically move? How far is it moving now? If it's moving like 50-60 ticks in 5 minutes, you know, that's it might typically move only like 10 ticks in 5 minutes. You know, you sort of know that because you trade that market, you know that market, right? If you don't know that market, you just do, you know, you just do like a rotational study like I've just showed you there. If that makes sense.
All right, thank you. Wags has a question here, and let's see here. How much time you got, Cam? Just want to know.
I can be here all day.
All right.
No, I'm all right.
We got questions. We'll close up questions here now, so if you got your question, then we're going to try to get to it. Wags has got a question. Please describe your scale in and scale out procedures. Be specific, if you could, please, with the amount of movement required to add a scale or remove a scale.
Okay. All right. So, I mean, in terms of targets, it's my targets are based upon sort of market structure. So, for example, now I was not long down here, but I just want you to sort of understand how I do business. Now, I firstly find value, and you can see there's sort of a value area here on the Bund, right? I've got buy zones down there, but they happen to hold out yesterday evening, which I'm I'm not trading. But what you'll see here is that this market sort of started to hold out those support areas, and we actually went towards targets, this high volume area, this high volume area. So I typically use those as targets, so I scale out based upon high volume nodes, high volume areas. But I do have another tool which is based upon harmonics of the marketplace. So let me just show you this. I have posted this on Twitter before. If you want this, just drop me an email. I'm very kind with this stuff. I do sort of give a lot away. So if you look at this, basically this is the harmonics and target ranges for typical markets that I've traded and basically have personal experience with. So Bund, ES, DAX, YM, Russell, NASDAQ, Euro stocks, crude oil, right? So if you're trading like 4 to 5 targets, your targets are different. If you're trading 3 targets, your targets are different. If you're trading 2 targets, your targets are different. If you're trading just 1 target, your targets are different. So depending on your position size and the amount of targets you're working, your targets change. So the objectives these are just harmonic targets, right? I will still review these targets based upon market structure, okay? So for example, the Bund, I might typically go between 8 to 12 ticks first target, or 18 to 22 ticks second target, and then 30 to 38 ticks third target, if I'm trading 3 targets. But I might look at the market and say, wait a minute, I'm long at 86s. The logical target is 96s, okay, which is 10 ticks anyway. And then I look at this and I think, okay, 21 ticks. So I use a sort of combination of harmonics and market structure for targets. Now scaling in is much more tricky. As I said, it is very much so about asking myself, how confident am I in this position? I'm using feelings rather than technicals, which I cannot be specific with because I don't even know what feelings I'm going to have in the next trade that I take. So as I said, most people want to hear the specific answer, but the reality is I don't work that way. The reality is I have the option, and based upon how I feel about that trade in that moment is going to really help me decide. I want 30 on, I want 40 on. I cannot know that ahead of time. So I could not give you the answer in terms of specifics and technicals. But I would typically look for the market at least moving in the direction of my trade. So if I'm long here, I might want to buy more if it's looking better, for example. So it's not something that I can really sort of give you an answer for with technicals, but it's based upon feelings. Because if the market looks better and I feel good about it, I'm going to buy more. If it's not looking that good and I don't really like what it's looking like, I'm not going to buy more. Now that's using your feelings. It's not technical. And this is a skill a lot of traders have lost because they have forgot how to use their human being skills, how to use their emotions, how to use their feelings, because they've been taught become emotionless, become like a robot, pretend you're not human. But the reality is you are human. You're going to have those emotions. Now, for example, like doubt, fear, and anxiety is something that everybody tries to avoid. But if I have doubt, fear, anxiety in a trade, I know something's missing. I know I need more confidence and something's not there. Because if I've done the right analysis and I found the right opportunity, I should have that belief and confidence. So, the reality is, if doubt, fear, and anxiety is there, or you're not ready to put that extra position size in, it's probably for a reason. And that reason is probably not on your charts. It's probably internally in your intuitive sense and feel. Right? So hopefully that makes sense.
All right. We got a guest here, CD127. We were about 25 minutes into the webinar, and he requested, can you do an order execution webinar? So maybe that might be a topic that
yeah, sure.
If we can do next time we get Cam on. So.
Yeah, I've got a good process for execution. Actually, it's a real eye opener for most people. So I'll be happy to schedule that in, Eddie. If you want to sort of schedule something in, we can talk, and yeah, I'll be happy to do that.
That would be fantastic, Cam. Definitely. We'll talk after the webinar.
Okay.
Got a question here. We still got a lot of questions. You still got.
I know. By the way, guys, if you got any questions, please feel free to drop me an email. I'm pretty kind. We're giving me information away. I'm not going to charge you and make you pay for like an email or something. So check out the website, and if you've got a question, just email me. on info@thetradingframework.com. You know, because I've missed a lot of questions and I did really want to get to many of them, but I obviously have a limited amount of time, and you know, I want to get to those questions, but I can't. So please email me. I'll be happy to answer your questions that you've got.
All right. Next question is. Sure, 1 second. All right. Where Mark Seflin's got a question. And Mark is asking, which of the Eurex products would you recommend for a U.S. trader new to the Eurex? I currently trade the ZB and the ZN.
Oh, wait a minute. Eddie, I don't know if you mind, but I've got a very good question here that I wanted to take from Big Arc 231.
Sure thing.
Yeah, is that okay?
Go ahead, take it.
Yeah, it's from basically he's asked, how long should you be trading before you trust your instincts and you know, beginner, intermediate experience? And I think that's a very good question, because if you're new to trading, you obviously don't have a lot of intuition, you don't have a lot of experience, so that becomes difficult. And that's why I say with a lot of new traders, they don't actually want to hear a lot of what I'm saying. But the reality is, most professional traders that have been doing this a long time, and I understand, I hear you, I understand where you're coming from, because I was the same. You know, you don't want to hear that you've got to use feelings, intuition, etc., because you don't have that yet. But what I say is basically, look, you will develop it, but you've got to be open to it. Okay, so what I suggest is basically you create a plan in such a way where you say, look, this is what I believe in, this makes sense, this is what I want to trade, and then leave your mind wide open for at least sort of 3 to 4 months and say, look, I'm going to build an understanding of this marketplace. I'm going to build an understanding through my experience, but leave yourself open to that, because if you don't leave yourself open to it, you probably won't receive it. But that intuitive sense, that feel will come. Okay, you have to trust me on this, but you have to also be willing to commit to actually receiving it, right? So that's the thing. So sorry, Eddie, I've got to take that other question from you again because I missed it.
All right, this one's from Mark Seflin, talking about the Eurex products, asking for a recommendation for a U.S. trader new to Eurex. He currently trades the ZB and the ZN. Which of the Eurex products would you recommend?
Well, I trade the Bund, and I think it's a great market. It's probably not the best market to move to right now because it's not what it's like normally, right? So I would suggest the Euro stocks is a good market. I actually used to trade the DAX a hell of a lot. And, you know, this just goes to show, I traded the DAX pretty much every day, Eddie, between 2006 and 2011. August 2011, it changed, but I recognize it changed because the bid-ask spread was like 6 to 7 ticks wide. You know, normally it was like 1 or 2 ticks. And I thought, wait a minute, something's wrong. I don't feel confident buying this market, shorting this market, you know. So I had to stop trading that market. And I traded that market for over 5 years. And then I had to say to myself, okay, well, what can I trade now? So I moved to the Euro stocks. But I was willing to adapt. You know, that's what I'm talking about. So right now, I would say the Euro stocks is a great product for beginners on the Eurex exchange. And I would say after that, I think the Bund. You know, the Bund is going through a phase where it's a bit more volatile than usual, but I think it's a great market to trade. I personally do find the European session easier to trade than the US session. And that is not to say that the US session is untradeable. I just personally believe that I am better with the European session. I understand the structure and the dynamics. You know, the ES is a great market, but I think there's just a bit more noise for me in the US session than there is in the European session. So I prefer the European session, and I think if you're in the time zone where you can trade the European session, I highly recommend DAX and Euro stocks, the Bund, and then the DAX. If you like more volatile markets, the DAX is the next best product. But the DAX is one of those markets where it's very attractive because it moves so much, but it's tricky to time. That's the issue with the DAX, right? So I think that, you know, the main thing you got to do is sort of commit to something. I'm happy to guide you and recommend like the Bund or the Euro stocks or the DAX, but you know, the truth is it's going to come down to what you like because everyone is different. So I might like the Bund, I might like the Euro stocks. You know, to tell you a story, I used to like more volatile markets when I first started trading. It's probably because you can get more bang for your buck with less size on a more volatile market. But it was only 5 years ago, in 2011, you know, 10 years after I've been trading, that I actually said, look, I'm going to commit to more liquid products and trade bigger size. So now I prefer more liquid products. So you will change and everyone is different. You know, that's the thing. So please take that into consideration. Don't ever ignore what your intuitive sense and feel is telling you. So firstly, you got to have a plan, but you got to execute that plan and then listen to what you actually learn over those few months or years or whatever it is. But listen to what you learn. Get the feedback from yourself because everybody is different.
All right, Cam, speaking of the Eurex, Mark has mentioned Eurex.com shows that the boom trades 7:30 a.m. pre-trade, 8 o'clock to 2200 regular time. Are these trading times in the CET, the Central European time?
Yeah, sorry, but basically the trading time windows I have, like they're different for the European markets, right? I don't know if this is what you're asking, but I think it is. Basically, the time windows I have for the Bund, for example, is 7 to 11 a.m. But that's based upon my London time, right? So that's when I look for entries. Now for the US markets, it's different. The US markets, for example, here I've got like morning session 9 a.m. to 11:15 a.m. and then the afternoon 1 p.m. till 3:15. So for me, those are the best periods to trade. Is that what you was asking, Eddie? Sorry about that.
I think it was just checking the times, trading times. You wanted to make sure and check if those were in the Central European time zone, CET.
Sorry, which times? Central European times for which markets?
For the Bund.
For the Bund, well, I'm not sure what it would be, but basically for 7 a.m. here in the UK, that's like really early for you guys in the US. So you either gotta not sleep or you gotta wake up really really early. So
No, sleep. There's always time to sleep. All right, Trader Sean's got a question. Do you think the Bund and the U.S. 30-year bonds are similar in terms of stop ranges, or would the Bund have a narrower or wider stop than the bond?
no, definitely the 10-year and 30-year US bonds, treasuries, the 10-year notes and the 30-year bonds, they are a lot slower. And I only look at them really for confluence. If I'm a little bit confused as to what the Bund bubble is telling me, I might look at those markets for some clues. But the 10-year and 30-year intraday are pretty much, for me, scalper markets. And that's why I don't trade them, because they don't really provide a lot of opportunity intraday. I think they're really good sort of markets to sort of hold overnight. So for the kind of risk reward that I'm looking for, it doesn't really suit my objectives. So I would suggest, for myself, I would say the Bund. But if you're looking like, for 5 to sort of 6 ticks, 7 ticks kind of movement and you're scalping, I think the 10-year and the 30-year are good products to consider. But for the kind of trading style that I have, which is what I class as intraday swing position trading, because I'm looking for those sort of bigger moves intraday, those on the Bund are a lot better and a lot more consistent on a day-to-day basis than what we see on the 10-year and the 30-year. So that's my opinion.
All right. Looking at the big picture, Sean's asking, I noticed a change in the bond market in mid-October 2014. You saw a change in the Bunds May 2015. Did you see a change in the Bunds the October 2014 as well?
It actually slowed down, if anything. So let me just show you the daily Bund chart again. Gotta load it up again. Hold on. Just give me a second. I'm trying to find the chart. Okay, actually I've got the bubble daily chart. Let's look at that. So the bubble daily chart is very similar to the Bund actually, because what you'll find here is that we actually started to become a lot more volatile here in May 2015. The last time really, and we got some more volatile periods there in 2013 as well on the bubble, and also back in 2012. So I mean there are periods there. I think the Bund is the better market for me, so I'm just going to try to bring that up again if I can. Just give me one moment, because it would just take me a second to load up again. There it is. Alright, there it is. So there's a Bund. So there's a Bund daily chart. If you look at the daily ranges, I mean that's obviously just part of the piece of the pie, if you like. It's not everything. But if you look at the sort of daily ranges, the last time we had a really significant shift in ranges was 2011. And then we had a spike back in May, June, July. in 2012, and then if you keep moving forward, we'll have the odd spike here and there, but nothing consistent like what we've just got recently. So you said 2000, I think it was 2013, and in 2013 there was a few spikes on some odd days, but nothing consistent. So sometimes, you're going to find that it is there on the 10-year, 30-year, not on the bund, and you might find, like right now, I've not looked at the 10-year, 30-year. The volatility increase might be a lot more significant on the bund than it is on the 10-year, 30-year. So it's not always sort of filtered through. You will find in most cases that if there's a shift in volatility, it sort of has a knock-on effect on other markets, but it's not always the case. That's the thing. You got to look at it, basically. You got to have to look at the markets you focus on and really sort of know those markets. Okay. So I think, Eddie, we've pretty much had enough questions there, yeah? So.
Okay. All right. Good to go. All right. Now I know that, gosh, you're in popular demand here. There's still a lot of questions.
I must have provided some good value then.
Yeah. Okay. Mucho value. But appreciate it. I mean, you did the above and beyond here. We got you here on almost an hour and a half, but appreciate it. We're gonna get you on here again very soon.
No problem.
Once again, I just want to make a point here that Cam said if you do have some questions, he does have the new website and contact information. It's the tradingframework.com.
There it is.
There it is. You got it there. You're going to post it there, and I'm going to post it in the Squawk Radio Room. If you'd like to, you can just click on that link. That's going to take you right there. Bookmark it, by all means. Bookmark it. But